Me, Stephen Thomas, with reports on housing. And today we're bringing the Southern California 2024 forecast and housing update. It's kind of like the way that we see the whole entire United States going as a whole, but we're going to focus and drill in on Southern California. But all of it applies if you're tuning in from outside of Southern California. And just a really brief introduction. Our company is Reports on Housing. It's your local real estate snapshot. And we're just about delivering the power and strength of data so that adults, human beings, can make really good decisions based upon statistics and all the best information rather than a narrative. We're not trying to push a narrative at all. We're just trying to give everybody the straight, honest, goodness facts, the way that we see it right now, what the trend lines are looking like so that everybody can make really good decisions. So, my background, I'm a quantitative economics and decision sciences major from the University of California, San Diego. Been in the business for decades. Orange County native. I graduated in South Orange County and at Capitol Valley High School, and I do have 9 kids. And our oldest daughter, she had a baby, so we are grandparents, and we have been all over the press. And our reports, they dot all over Southern California. We just added this year the Bay Area and Ventura. Next year it's Phoenix, Vegas, Sacramento, and so it's going to be a busy 2024. The most recent article that we wrote, these are the reports that come out on an every other week basis. The most recent one is called a split market. That split market just talks about the differences between the luxury, which is the top 10% of a county, and we look at the county as a whole. The top 10% behaves way different than the bottom 90%. And as far as the movement of the market, it's very sluggish in the upper end compared to the lower end. So we are nerds, geeks, absolutely love what we do. This is all that we do. We're housing analysts. This is our lane. We stick to housing. We're not on Wall Street trying to talk about economics for housing, which so many firms over there in Wall Street try to do, but that is not really their proper lane. We do have a economic model we follow. It is called a progression model. That is because there's new data that's coming in all the time, especially this week. So this was originally supposed to air yesterday, Thursday at 3 p.m., the day after the Fed met. And it took longer to put together. And then we had a sound problem. So we are here on a Friday, just a couple days after the Fed met. And we're bringing you the latest and greatest as of even this morning. So this is where you go to subscribe. If you want to subscribe to the report, it's reportsonhousing.com. It's $15 per month or $150 per year. It's insanely cheap on purpose. And you get your first month free if you sign up utilizing the coupon code on checkout of 2024. And if you like what you're seeing today, I invite you to subscribe and like our channel. It just helps out with all the, of course, YouTube algorithms. I see myself and our firm as we're professors, teachers. What we're trying to do is educate the masses as to what's really going on out there. And it's like I said, I really don't have a narrative to push. It's not going to be all about crashes and doom and gloom. It's going to be about what's really going on. If there was crashes and doom and gloom, which I was writing reports back as early as 2004, we definitely saw the Great Recession coming, and we were talking about it. We called those major cracks. But we're going to call it like it is, and so that you can understand what's going on yourself, as well as clients, as well as just anybody out there that's even watching this video. You're going to learn quite a bit about housing. So let's talk about rates and the economy, because that is really what's going on right now. It's really changing. There was a sea change this week in mortgage rates. And where we are right now today is still what we refer to as uncharted waters. And the reason for that is everybody likes to stick things into a nice little box and say, we've been here before and this is how it's going to behave. I've heard of the 70s and 80s, their inflation, nothing close. I've heard the 40s, and 50s after all the wars. That's not really where we're at. It's like trying to stick it into something that it just isn't, and that's why there is so much uncertainty out there, and that's why there's volatility in interest rates, and interest rates have been all over the map, as well as so have markets. So this has been all about inflation, and originally the reason why all these rates hikes went up is because of inflation. And inflation is very, very tied to COVID. COVID is now getting further and further back, so a lot of that COVID stuff is starting to wash out. And you could see it in the inflation numbers. Now, the Federal Reserve, this is Jerome Powell and all of his minions. They've been very, very busy inflicting pain on everybody out there. They said, the general public as well as companies. They said that as early as September of 2022, right after they met in August of 2022, said they're going to go higher and they're going to stay there for quite some time. Now, as a result, we saw interest rates last year, they just ballooned up. But even this year, they went up further. As a matter of fact, there were 4 quarter-point changes that the Federal Reserve did with their short-term rate. Now, remember, we're going to talk a lot about the Fed changing rates. What they have control of are short-term rates. That is credit card debt, automobile loans, equity line of credit. It's not 30-year mortgages. 30-year mortgages are more, the movement is based upon what happens with mortgage-backed securities and traded on Wall Street. And that doesn't go hand in hand with the direction of the short-term rate. Now, where 30-year mortgages want to be is where everybody feels that where the Fed should be on their short-term rate down the road, because they don't want to have rates that are so much lower than the federal funds rate. So they kind of mix a little bit, but they're foretelling where the Fed is going to go, which is very important to understand, because you can actually have a rate hike of short-term rate from the Federal Reserve, yet the same day you have rates 30-year mortgages that come down. So know that they don't tie one to one. This is inflation. Looks really pretty. I have on here, most charts don't even have all this stuff from the 70s and 80s. I like this chart because it puts everything in proper perspective. It doesn't try to do a song and dance that, oh my gosh, things are still way out of control. No, they're going down, and Fed knows it. This is why they're starting to talk about reducing the Fed funds rate next year. And they know that if you pull out all these things that have lags like shelter, that we're really getting back towards that 2% target level, which is where they really want to be. Now, so know that this looks actually really good. It's slow and boring, and I like what it looks like. So the consensus was we were supposed to have a recession. Did not have this said recession because the United States is extremely resilient. And GDP has been off the charts. Now, the reason that it was off the charts in the third quarter, and as well as this entire year where it's been above 2%, is because of the consumer. Consumer consumption has been off the charts because of a variety of reasons. Consumption is 70% of GDP. So when they say that the economy is really resilient, GDP is really strong, it's because consumers have been consuming, and nobody does it like the United States does. So that's why we didn't go into a recession, but there are some headwinds and some things that we'll get into in a second. But you have to understand that on the job side of things, this is really where the Fed is focusing. Jobs, more recently, you can see this because it was, we had jobs reports at the beginning of this month, and you can actually see the job openings are actually coming down nicely, and that's why we had mortgage rates already starting to come down. Now, this jobs report, November jobs, where it was up 199,000 extra jobs, this was a little bit higher than what expectations were, but not a big deal. Now, as far as retail spending on the right, retail spending is where we've seen a lot of juice. It was flat from September to October, but then we looked at November, and November was higher. So, that was a report that came out this week, and it was a little bit higher than what expectations were. But this just further tells the story of why we're going to have the slowdown later on, because you can't continue to consume at the pace that we're currently consuming. Now, the Federal Reserve they met this week. And they had Jerome Powell had his news conference on Wednesday, and they were very, very hawkish just a couple months ago. In September, they came out. They sounded like they came out swinging. There was a big change, a sea change from September, where they were extremely hawkish, to December, where all of a sudden they're what they refer to as dovish, which means they're starting to say things that are a bit different, where they're saying that there's a top to where they see that they've already hit the highest level they need to be as far as the short-term rate, and now it looks like that there's a pathway for rates to come down next year. And they're already starting to unwind it. I listened to one of the Fed presidents this morning saying, wait, we're not really talking about reductions, but they're trying to reel everybody's expectations in so that the mortgage rates and 10-year treasuries don't fall too much, and they need to curb their enthusiasm over at Wall Street. Now, the Fed dots, they come out every single quarter, and this is what I was talking about. In June to September, they released dots, and they were way different in September from June. They said that next year that they're not going to reduce as much. And then from October, actually from September to now, December, now all of a sudden the dots came out again for this 3-month period, and now all of a sudden 2024 it's coming down 3 times. And you can see that in this chart, that the big difference between the reports back in September to December is that red line right next to where it says 5.5. You can see the red line was in September. Now they say that they're going to be another 0.5% lower than where they thought just in September. So that's the big change. And it was more of what Jerome Powell and the Federal Reserve had to say about what they're going to do. And I see this as the initial green shoot where we've hit a top. Things have been really low as far as the number of closed sales in across the United States, and now it's really only up from here. It's been bare bones. So this is the first green shoot that leads to that pathway of doing more transactions, more buyers getting in because now they can afford to own a home because rates are coming down. Now the traders on Wall Street, they're looking at both stocks and bonds. Now if they're not investing in stocks and bonds, what are they doing? They're parking it in cash. And that's what they had been doing. And like Warren Buffett had more cash than he's ever had before. So I have a lot of investors. But you can see, when did they enter? They entered this week when all of a sudden they heard that the Fed is starting to pivot in their language. And all of a sudden you saw a whole bunch of people flood 10-year treasuries as well as mortgage-backed securities, and we saw interest rates fall. So when the economy is as hot as it is, it is between 6.5% and 8%. We're right now really close to that 6.5%, but it's still within that range because the economy still needs to cool from here for rates to come down materially more than where they are right now today. Because today, as of this morning, they're at 6.62%. You could see that waterfall drop. That was just this week. It was over 7%. We're down to 6.62%. Back in October, we hit 8%. So this is a big deal because when we went from 7 to 8%, 5 million borrowers, potential borrowers across the United States could no longer afford a home. But when it went from 8 down to 7%, now 5 million borrowers can now enter the market. And now that it's falling more people can now qualify and go ahead and look for a home. So it just opens up a seagate of potential buyers. Now we talk about treasury bonds because our investors look at 10-year treasuries as well as mortgage-backed securities. So 10-year treasuries and mortgage-backed securities, that investor that's looking at one is looking at the other one. Because when the yields on 10-year treasuries go up, mortgage-backed securities also go up. Treasury bonds go down, we see mortgage-backed securities go down. So they kind of go hand in hand, and it's been doing this since 1972. It's kind of like a little love affair. And you can see right here that this is where we were, 3.906. This was all the way up to 5%. And this is 10-year treasuries. And that's when we had 8% mortgage rates. Well, now you can see it's come down quite a bit. It actually is a waterfall dive. And there we are. We're way down. It's actually at, I said 2008 was the last time we were at these levels. And you can actually see that there's been a lot of movement. The movement was from February, where we had 5.99% interest rates, and we had for a day, and then we had the jobs report come out for January that was over 500,000. All of a sudden you had 10-year treasuries and rates go up, and then you had the banking crisis, rates caved, and then you had for a long period of time, that long black line, we had an economy that was continuing to grow, and it looked too strong, so it continued to go up. And that red line is when in September, when those dots came out, and the the Fed was way too hawkish. All of a sudden, we had this big jump. And then slowly but surely, we started to see from that point on, the Fed presidents got out and said, wait a minute, we're being a little bit out of character here. We're a little bit too hawkish, as well as we started to see things in different jobs reports and different readings, CPI. And then we watched interest rates come down. And then that blue line is this week. All of a sudden, we had this waterfall dive. And that dive was because of this change in language from the Federal Reserve. So I'm showing you that. Now I'm going to show you this. Same thing. This is mortgage rates. Does the same story based upon the same information. And this is why we follow 10-year treasuries, because you can watch 10-year treasuries during the day to see exactly what's going on with interest rates for the day. And if you look today, they're kind of flat from yesterday. So not a lot's going to happen. It's not going to continue down if you're wondering if they're going to continue to go down. We have to have something more materially happen for rates to continue to fall. So there's been an economic miracle of averting a recession. And that's because of fiscal stimulus. We've had way too much fiscal stimulus from both administrations. Last two, I think, were way too much. We're putting too much money into the system. Then we have depleted savings. That's averted this recession, as well as locked-in mortgage rates. A lot of people are locked into fixed mortgage rates. They've got a good job. It's not that, even though we've had this inflation problem, yeah, it's a bummer, but they have this fixed low rates that they refinanced or purchased back in during the pandemic. So there are economic headwinds that are out there. Know that one of them is the savings rate. The savings rate across the United States is way lower than where we were prior to COVID. As a matter of fact, it's the lowest since 2009. And then you also have this excess personal savings. That's the extra money that everybody got from COVID relief. And now there's $500 billion left. This is waning. They're running out of this excess savings. So consumers aren't saving as much. They're running out of their excess savings, which means that they're not going to be consuming as much when they run out of this excess savings because they're not saving very well. And then you could see credit card debt. Credit card debt is just been skyrocketing, and this has been a concern as well. So people are putting a lot of their purchases on credit cards and understand that those have much higher interest rates than where we were at just a couple of years ago. And there is a lag to everything that the Federal Reserve did in jacking up mortgage rates. And know that this fuse is a little bit longer than what everybody had anticipated, but it's definitely going to hit the system, these higher rates. That's why they changed their language, because they're concerned that they're going to get towards 2%, and yet they'll finally react and it'll be too late and it'll cause deeper damage within the economy. And they don't want to do that because you can already see that there's this commercial real estate wall of debt where $1.4 trillion is going to mature between 2023 and 2025. And know that what they're referring to is when you buy a house, you typically, if you get a loan on it, 30-year mortgage, after 30 years you pay it off, you own it free and clear. That's not the way commercial real estate works. You have a commercial building, you put a loan on it, it matures after a certain amount of time, and you have to get a new loan. And so this, a lot of commercial real estate the debt is, they're pegged to very low interest rates, but once it matures, then all of a sudden it's due and payable. Now, there are funds, like there's this fund that owned 10 hotels. They turned around and actually, after it came due about 6-8 weeks ago, it became due, they had to get a new loan. It didn't pencil out after with the loan where the interest rates were at. So you know what they did? They walked away from these 10 hotels, and that's kind of what's going on right now, and that will continue to go on as long as these rates remain as high as they are. So this is going to be a drag on the overall economy. So we're kind of hitting the top, this precipice, and what that is the economy kept on looking like it was continuing to go up and it would never slow down or never cool. But we're getting to the point where it's the writing's on the wall that it's going to start to come down, and that's going to be 2024. It's just a matter of when is it going to occur in 2024. So something's going to break, and we're going to actually see that things slow down. The United States slows down, and then more people will then go towards that safe haven, that cash that's on the sideline. And where are they going to go? 10-year treasuries and mortgage-backed securities. And when they go there, what happens? Interest rates fall. And then when is that going to happen? I don't know. It's like fishing. Exactly when is that going to happen? Nobody knows. We're in uncharted waters, but we have an idea of what it's going to happen. For us right now, it's looking like it's definitely going to happen within the first 6 months of 2024. There is a slight chance that it could happen like in the fall of 2024, which would be a little bit late. when it happens will affect the real estate market because we'll have lower mortgage rates. So know that when that shift happens, that's when we get below 6.5%, we go to 6 to 6.5%. And then things can slow down a little bit more, which we anticipate. Doesn't mean we're going to go into recession. It just means that, see, for recession, you have to have 6 months of negative growth where it's negative. We can get like 3 months of it, maybe, really slight too. So it's not really a recession. And even if it was a recession, it would be more like a slow session. It would just be slight, not a lot of job loss. But even though we go into that recession, it's going to kind of like reset the economy a bit. And now we have interest rates between 5 to 6%. And people go, you can't get to 5%. Absolutely you can, because right now the spread, I told you, the 10-year treasury and 30-year mortgages, they kind of go together. There's actually a spread that's 1.75 that goes all the way back to 1972. And now that spread is higher. So interest rates are actually higher than where they should be. Today, interest rates should be closer to about 1% lower, so the mid fives. So that will happen down the road when the economy resets and there's a lot less uncertainty in the marketplace and inflation's down a lot more. So this soft landing that everybody's talking about, I want to tell you, it jogged my memory and I was going, man, I think I've heard this before. And yes, we have heard this before. All of these headlines where Fed jobs report confirms soft landing, Fed chairman projects soft landing. There's 4 different articles on here. What are all the dates on these? Look closely. 2007 is when these articles came out. So there you go, 2007, all 4 of them. And that is just tells you that they really don't have they didn't have an idea then in 2007. And we started the Great Recession the year afterwards, the biggest recession since the Great Depression. So do they really know exactly where they're at? Absolutely not. So it's kind of like looking in the dark. So you can't see much and trying to feel your way around to even move around. So that's kind of what it's like. So they're not absolutely 100% certain as to where we're going to go, where they're going to go. And we all have really good ideas about where we're going to go based upon trend lines, but things can change. Doesn't mean we're going into a Great Recession. Absolutely not. That's not really. There are a few doomer and gloomers out there, but they've been talking about these the crashes of all crashes for decades. They're called perma bears. So flaps down, gears down, ready for a soft landing. This is something I pulled from 2008. Now, I want to point out, here's another thing, and just know that it's very hard to listen to everybody that thinks they know exactly what they're talking about, but understand you have to take everything with a grain of salt, because this is even Fannie Mae. They do a housing forecast and an economic forecast every single month. Wish that we could do that. But their forecast they do mortgage rates, and I want to show you mortgage rates. They thought in April, when we had that banking crisis, that we should have interest rates at 5.7% by the end of the year. Instead, it was a little bit different, wasn't it? How are those 5.7% interest rates working out? And then at the end of 2024, 5.2%. That changes every single month. It was going higher and higher and higher. And you could see this in October. It was at 7.3% by the end of this year. And then 6.7% by the end of next year. Now they've changed, and this was in November, 7.7% for the end of this year, 7.1% for the end of next year. They haven't released December. I'm sure it's going to be in the 6s. They have no idea where we're going. They're just kind of like everybody else, feeling in the dark. However, there are ideas about where things are going when you map things out. So you could take this with a grain of salt, but no one really knows exactly where interest rates are going to go, but know that there are levels that they're going to go. And so prognosticating 7.1% was a little bit off base, because if you looked at projections going forward, it's not that accurate, especially given where they were at 5.2% or 5.1% back in April. Let's talk about the housing market. But first, I'd like to bring in our sponsor. Thank you so much, JJ Mazzo, for sponsoring this event as well as many events that we do. JJ Mazzo is the executive vice president at Cross Country Mortgage. They're the #1 retail lender nationwide, Scotsman Guide, nationally ranked top 200 mortgage originators, over 25 years and over $2 billion personal home loans funded. And I'm telling you that JJ Mazzo, you can plug into his energy. He is out of this world. So really, really incredible human being, and knows his stuff. Yeah, like I said, plug into him. He'll take care of you and your family. It's they have a same as cash $1,000 per day closing guarantee. They have deposit protection up to $100,000. You could talk to him about these different programs. They have a rescue 911 that if there's something wrong with your loan, you know what? They're going to come in. They're going to rescue your loan. They can close as quick as 10 days with still having that $1,000 per day guarantee. And all loans are processed, underwritten, and funded in-house, allowing you to close in as little as 10 days, same as cash. So reach out to JJ Mazzo with the Mazzo Group at Cross Country Mortgage, and you can reach out to him at 877-237-9694. That's 877-237-9694. Thanks, JJ, for your continued support of our programming. And so back to the homeowner, the housing market. The overall housing stock is extremely strong. It's argued it's between 40 and 42% of all United States citizens own their homes free and clear. It's the highest of all time. And know that the homeowners collectively have strong credit, great jobs, low fixed payments, which are a hedge against inflation and rising rents. They have record tappable equity, which means they can tap their equity and still have 20% equity in their homes. And there are more equity rich, which means they have 50% more equity in their homes than ever before as well. So know that right now, this has been a year where we still have had seasons, haven't really felt it in the housing market, but they are there. We can see them. Spring is number one, then we have summer, then we have autumn, then we have winter. Winter's where we're at right now. It's when things really slow down. Fewest number of homes come on the market in December, second fewest in November, and then we have demand that typically falls and inventory that falls during this time period. Then we get off to the winter market, second week of January all the way to the second week of March, and that's a totally different market than the holiday market as well. Now this year we've been cruising along, inventory levels at very, very low levels, as well as demand levels at very, very low levels. They both have been extremely low cruising altitudes. And know that Jerome Powell, the Federal Reserve, and all of his minions wrecked the housing market. What was strong, they said that they were going to reset it. They said that in June of 2022. And then in September, they said what that meant, bringing a better balance to the market. Yet they stomped on not only the demand side of the equation with higher rates, also the supply side of the equation with higher rates. There is a housing shortage that is out there. And no, it's been hard to be a buyer because there are very few homes that have been coming on the market. There's a scarcity of product that are out there. So even in these higher interest rate environment, especially in the entry level, there are multiple offers and it is very hard to secure a home. Plus, we've had mortgage rates that have risen for the most part all this year and until just now. And then home values have been going up as well this year. Slowed down a little bit the second half of the year as interest rates have remained above 7% since the end of July until this week. And so as far as the inventory across the United States, this goes all the way back to 1983. Prior to the Great Recession, we actually had its buildup from year to year in inventory until we got to 4 million homes during the Great Recession. And then since that time, 4 million, Dodd-Frank was adopted in 2010, made it very hard to get a loan unless you really qualified for a loan. Adjustable rate mortgages were pretty much gone because they had to explain to you exactly how much your payments could adjust to. So they're pretty much gone. The only kind of adjustables that are out there, because they used to adjust on a monthly basis, are fixed for like 5 years, 7 years, 10 years, that type of thing. So inventory as a result has been coming down, and it really came down after COVID started. And it went from 4 million homes to where we are today. We're stuck at 1.3 million, and it's coming down right now. And as far as where were we prior to COVID in January of 2020, each of those Himalayas is a year. In January of 2020, we had the fewest homes for a January ever since they started tracking this data back in 1983. And I'm going to argue way fewer citizens and households back in 1983 compared to all the way in 2020. So even prior to COVID, it had already drilled down to a very low level, which is why when we went into COVID, I knew that we were not going to get all of a sudden home values dropping like so many people had originally thought. So this is the inventory in all of Southern California, still extremely low, lower than where we've ever been before prior to COVID, and this goes back to 2012. We have it in Orange County. We go back to 2004. That's where we started, and it's the lowest level prior to COVID since 2004. It's since we started tracking. And as far as Southern California active listings, now we snap these numbers every other week, but then we have an update every a week later, and that update is today's numbers. So last Thursday we were at 22,500 homes on the market. Since we started the holiday market a month ago, it's actually dropped 1,266 homes. 5%. Last year we were at 27,479. That's 22% higher. That's the orange line. And the 3-year average prior to COVID, 2017, 18, and 19, when things were normal, was 35,962. That's 60% higher than where we are today. And that's like near where that purple line is. Now today we're at 21,834. So we actually came down another 700 homes in just the last week alone, down 3% in a week. So it's really falling right now like it normally does. And so where normally we peak during the summer between July and the end of August, the rest of the country in September, but this is SoCal. They peak between July and September, and yet it didn't peak there. It peaked later. And the reason it peaked in November is because interest rates kept on going up higher and higher, remaining above 7% since July, and they went all the way up to 8% in October. So there were people that came on the market, and a lot of people couldn't afford to purchase any longer that were in the market, because even when we went from 7 to 8, there were a few people that were playing, but there are even fewer when interest rates continue to go higher. So there's this trend going on called kicking back, and kicking back is definitely occurring in the United States as well as in California. In California, and this is from the National Mortgage Database, through the second quarter of this year, 85% of all Californians have an interest rate of 5% or lower, 69% have an interest rate of 4% or lower, and 30% have an interest rate of 3% or lower. And you can understand, when you had it, we're at 8%, people are not going to trade in their 3%, go find else, move up and get an 8% mortgage unless they are loaded and have a giant monthly income. That's not the average Joe that's out there, which is keeping people in their homes. And so the number of homes coming on the market, we've been tracking since COVID, because I knew it was going to be a problem during COVID. And if you look at each month compared to the 3 years prior to COVID, 2017, 18, and 19, you can see that initial COVID lockdown, we were missing about 25,000 homes, 9% fewer homes that came on the market. Now, last year, especially the second half of 2022, missing 19%, over 51,000 missing for sale signs that normally come on an annual basis. Now, so far through the month of November in Southern California, 39% fewer homeowners coming on the market, and over 100,000 missing for sale signs. This is significant, and it's really eaten into. High rates eat into demand, but so do the lack of homes on the market eat into the number of homes that can be sold. And you can see here, this is actually a green shoot, or the start of a green shoot. We'll be talking about this like crazy next year in our reports. The reason for that is, see that? The orange line was last year. The blue line is this year. There was actually a few more homes placed on the market in November compared to this year, compared to November of last year. Now that orange line was last year, the green line was COVID, and the red line was 2021. Everything else kind of plays the same every single month, as you can see. So the number one month for homes coming on the market is May. By the way, we're in these on the right-hand side. December, very few homes come on the market. But this is going to be a green shoot that we're going to be able to talk about, and we're going to be able to see that this breaks out next year as rates continue to ease a bit. So we have this low supply. We're now going to talk about low demand. And low demand has everything to do with higher rates. Higher rates, if you wanted a $4,000 per month, by the way, that's kind of normal for Southern California, but $4,000 per month desired monthly payment with 20% down is for, when you're at 8%, the with $4,000 per month, you could only afford a $681,000 home. That's just principal and interest, 20% down. Now that it's at 6.5%, almost there, now it's at $791,000, $110,000 more in purchasing power just since October. And there is a pathway to get to 5%. Now you're at 931,000. So even at 5.5%, you're at 880,000. So you get the picture. As interest rates come down, it's going to open up the number of homes available. Not homes, the number of buyers that can now purchase, and more buyers will come into the marketplace. So that is where we are going. That will be another green shoot of demand as we see interest rates continue to ease. Now, when we had 8% mortgage rates, this is what happens. This is, of course, according to Black Knight ICE. And we're just at the most unaffordable place that we've been at since the 1980s. In Southern California, it's actually beats the 1980s for a little while in many different markets because of how high prices are. So yes, interest rates were 18%, but values today are way higher than where they were back in the 1980s. Now, as far as demand, this is a snapshot of 30 days of pending sales activity. That Himalaya on the right is 2023. Not a very large Himalaya. It's not a lot of pending sales. And you can see that in the blue line. This is what I meant by cruising altitude. On December 7th, last week, we were at 8,000. That was, in the last month, it went down 9% or down 750 pending sales. Last year, we were at 8,202. That was up 3%. That's 3% higher. It's very close to where we are today, which will be another green shoot because we're going to be able to see when demand breaks out compared to where we were last year over year. So this will be a green shoot going forward. Now, the 3-year average prior to COVID is near 12,000 homes, which is 50% higher than where we are today. And today we're at 8,083. Why? Because now we have interest rates that are coming down and it's not even fully absorbed. So we're actually going to do something not normal for December. Demand is going to rise from the last report that we did on December 7th to when we do it next week on the 21st. We crunch the numbers. It will rise again. And there, you can already see it went up 1% in the last week. It won't rise like crazy, but normally it is falling at this time of the year. And you can see this is where we peak. We typically almost always peak between April and the end of May across all markets because that's the springtime. People like to close during the summer. A lot of families like to as well. So that's why it's the busiest time of the year. And slowly but surely it's been going down. But it's not really like falling like crazy like it normally does this time of the year. And even with the higher interest rates, it would have still continued to not really go down, crater. And the reason for that is because of just inherent demand. There's a lot of cash buyers that are out there. There's a lot of people that don't care. That they have a lot of money in their pocket. They'll go get an 8% loan. It doesn't bother them. Or they have the bank of grandma and grandpa, mom and dad. Somebody's giving them money to do things. You're saying there's not that many people out there. Demand's not that high. So that's a lot of the people that are currently making up demand. Now, the speed of the market has gone from really fast during the spring to really slowing down right now. And you can see where the expected market time is right now. Yes, it's a lot higher than where we were earlier this year, but still, it's been higher in many different markets. And that you can just see across the board. This is the time of year typically when it takes a little longer to sell a home. Now, on December 7th, last week, we were at 85 days. That's 3 days higher than where we were a month ago when we started the holiday market. So we started at 82. That's if you place your home on the market when you open up escrow. That's what everybody should care about. It's not days on market. This is way more of a speedometer of exactly how fast the market's going today. Last year, we were at 101 days, so slower. The 3-year average prior to COVID is 92 days. And actually, today, we're at 81 days. It fell 4 days because demand actually went up and inventory is going down. So it's getting a little hotter right now at the end of the year. We were at 45 days during the spring, though, and that is extremely hot, almost unhinged. And that's when we had multiple offers, but you can see how things have changed over time. Now, we're dealing with supply scarcity. This year, we had a very, very scarce supply, and affordability crisis was not as bad as where we were in October and November of last year. We got down to 5.99% interest rates, and people went crazy. And not a lot on the market was the issue. But then as the year progressed, supply scarcity started to wane and affordability crisis grew, and it became more of an equal tug of war. So we went from a hot seller's market. It's still a seller's market in a lot of the entry-level markets, as well as everybody knows the price ranges that are still hot. But there are many markets and cities that have moved more towards balance. And then there were more that were even moving towards buyers. But now with interest rates dropping as much as they did, all bets are going to be off. This is going to change our market like crazy going into 2024 just to start it off. So if you're holding off thinking that it's going to be a buyer's market soon, it's not really in the cards based upon everything that we're seeing. Now, as far as the different Southern California markets, know that this just shows you collectively that the markets today, market time, I got that yellow square rectangle, versus 1 year ago, it's faster in all markets. Orange County being the fastest at 59-day expected market time versus 84 last year. And the slowest is San Bernardino, 100, but last year was at 122. So across the board, it's a bit faster than where we were just a year ago. Now, real quick market overview. I want to show you that values are up across the United States. This is Freddie Mac Housing Price Index. I'm not going to go into all the different counties that we cover, but it's up 6% year over year for the United States, up 0.1% month over month, and it's up 2.6% from the 2022 peak, which people thought this is the final peak in June of 2022, but it's actually up 2.6% from that. Not giantly juiced, but I'm telling you that it's actually hit an all-time record for the United States for the month of October. And there is a shortage solution. There will be more homes that finally come on the market. That doesn't mean that they're going to be sitting and languishing on the market. That just means more available homes to purchase, which means more escrow activity. Because what we have to happen in order for this to happen and more homes coming on the market is we actually have to have interest rates come down into the fives, which is where eventually they're just going to bottom out. Someplace in the fives is what we're kind of seeing right now. Can they go lower? Absolutely. But that's what we're seeing right now. And when they get to 5%, know that the more that they come down, the more demand that opens up. It will finally, the closer we get to 5, because it's hard to believe we even talking about a 5 handle, because we have a 6 handle now. We were at 8 just a couple months ago. So 5 doesn't seem, we can go down another percent to get into the 5s. Now know that you have to have the economy slow in order to get there. And when that happens though, it's not going to be so slow that interest rates that these levels in the 5s are going to entice a lot of buyer demand. There will be more homeowners that can finally move, but the more that come on, this is going to be a slow dial. The lower you go, the more homes that come on the market. However, they will be outpaced by the amount of demand that's out there. So all the new homes, the homes that will be coming on the market will be eaten up and placed right into pending status. So the available homes will still remain way low. We'll just be doing more transactions next year. So demand will of course skyrocket. And when interest rates happen, and like I said, more homes will come on the market down the road as they get closer towards that 5%. And then here we are. When is that going to happen? I don't know. So exactly when that's going to happen, we have our ideas that'll lead into our forecast. But the time is now to purchase, because down the road, what I just gave you a recipe for with more demand is values going up. So sitting around waiting for values to crater is just not a good idea. Taking advantage of rates that are falling and are way lower today is a much better idea for your family than waiting for home values to crater. And so Southern California closed sales, know that it's way down year over year, down 23%, even last year was down. So it's down to bare minimum levels across the United States. And as far as the number of distressed homes, there are 177 available in short sales foreclosures in all of Southern California. People always get into pickles. Even prior to COVID, at this time prior to COVID, there were 504. Which is a lot more than where we are today. So there's a lot of room for growth from here to 504. And this is election year coming up. Know that it will not affect real estate at all. People do not make decisions based upon elections. They will, the presidential administrations can affect the overall housing market down the road through policies, but it does not affect the housing market. And know that there will be plenty of articles that will be clickbait that will be written about it, but it will not be anchored in any data. I've never seen any data that illustrates that it will slow things down. So let's get to the 2024 forecast. And basically, I don't quite see where we are going. So let's take this slowly. My concerns are uncertainty, rates remain high, sticky inflation. I'm not really feeling sticky inflation. I just hear some smart people say some things that make me go, Fed overshoots and causes a deeper recession. Sounds like they finally are not going to. They've learned their lesson from being slow to move in the marketplaces. That's what it sounds like right now. But they're already starting to walk back some of what they're saying because they don't want to see the 10-year continue to fall, as well as interest rates continue to fall, as well as Wall Street continue to go crazy. So we'll just have to wait and see how the Fed continues their narratives out there. Labor market market remains too hot. Don't anticipate this, but this is a concern. Kickback trend remains elevated. Don't anticipate this. We anticipate green shoots. Global, with more people coming on the market. Global turmoil, that's a concern. Washington, D.C., they're always a concern, almost always on here for me as a concern. So my forecast is this: extremely low inventory to start the year, about 18,000 homes in Southern California. That means not a lot of homes across the United States. It'll be 2022 is the lowest number of homes coming on the market, then 2021, then 2023 will be the third lowest in many, many, many years. It will be lower than the number of homes that we started off this year with. Know that is a shoo-in for what's going to happen in SoCal and probably across the United States. And distress rises slightly, no real wave. Luxury has a sluggish transition to normal, longer market times. As there's volatility in the stock market, that kind of slows the pace of luxury. That doesn't mean values fall down. It's just normally supposed to take longer for luxury to sell. Interest rates are from 5.75% to 8%. We're not going to get all the way up to 8%. We've been doing this in September. It's already coming down nicely. So we have 3 different scenarios, and we actually give this first scenario, it's about a 40% chance that the economy cools during the spring and a 50% chance that it does it by summer. And there is a 10% chance that it happens as late as the fall. So those people that think that we're not going to get 5% interest rates, like 5.9, 5.8% interest rates, know that you're hanging on to scenario number 3. Now, scenario number 1 is like I said, it slows down during the spring. It drops between 6 and 6.5%. Those are mortgage rates. Now we have a rise in inventory to only 20,000 homes in SoCal, so not going to get a lot of buildup in inventory across the United States. Homeowners continue to kick back, starts to ease in the late spring. More homes coming on the market because the difference between where their prevailing rates are today and where they have locked in fixed mortgage rates starts to dissipate. The demand picks up due to rates dropping. Bidding wars start in late spring, and rates drop below 6%. During second half of 2024. And I don't know why I threw in late spring. It's just going to happen during the spring. So rates drop below 6% during second half 2024. And closed sales up between 14.3 to 20.7%. Like to be exact, if you know, really, that's us calculating out. Home values rise in 2024, up 6% year over year. Now, no matter what scenario, we actually see more homes selling next year. The second scenario, the economy cools during the summer. Now we're at 90% chance by the time we get to summer, something should happen. The economy should cool and we go down to that next level. Rise in inventory a little bit more, 22,500 homes. Homeowners continue to kick back, starts to ease in later in the summer, and then demand muted during the spring, picks up in the summer. Buyers cautious and not willing to stretch until the summer. And then we have rates drop below 6% at the end of the year. Closed sales up between 10.3 and 15.7%. And then home values rise between 0 and 3% year over year. Now, if it happens during the fall, 10% chance. I really don't see this happening, but could it happen? Absolutely. The economy could be resilient and people continue to dip into their credit cards and everything else a little bit longer than anticipated. Then you have rise in inventory to 26,000 homes. Homeowners continue to kick back, starts to ease in the fourth quarter, and demand muted during spring, summer, does not pick up until the autumn. And then buyers extremely cautious, not really willing to stretch much in 2024. Rates remain above 6% for the entire year. Now, closed sales are still up between 8 and 11.6%, and home values drop between 0 and 3% year over year because it just happens later. So thank you. That's my forecast. I do want to remind you, we do have a podcast. The 11th just dropped this week, and it's called Green Flags for Now. And we did this prior to we did this on Friday, and there's already better news that happened when we dropped this, and green flag that the Fed even made that announcement. Go to reportsonhousing.com, click on subscribe. You'll get the most recent report. You get your first month free too if you utilize the coupon code 2024. I really appreciate it. Thank you for tuning in. I hope you have a great finish to this 2024. You subscribe to our housing reports. You like this channel and subscribe to this channel, and just keep the love going. We're going to bring you the latest and greatest so you can make great decisions. Thank you so much. Stephen Thomas from